Good morning, everyone. Okay, so tell me any problems, any issue. Then remaining part I will discuss with you, dear. Okay. Okay. Three questions I am getting it. One is from Siladitya. You asked. Sir, yesterday. Acha, okay, fine. The yesterday what you asked is clear. Now you're asking, sir, there was US tapering Federal Reserve and effect on Indian bonds. Can you? Okay. Bonds. Can you please clear the concept? So it's confusing, Siladitya. Okay. Few months ago, the tapering of USA. Tapering means okay. Just you take normal. What's happened? This effect. Because if you go and just see that the interest rate differentials and capital inflow and outflow, that topic I discussed with you. So few months back, or you take the earlier, I mean, even the last, I mean, in starting one, even 2021, last it's started. Because USA started the contractionary monetary policy, they started increasing the uh, lending rate of interest, policy rate of interest. Okay, so increase in policy rate is started increasing all the rate of interest, all the return in the USA, and we felt the outflow of capital that time. That's a foreign capital FPI. They started leaving the Indian economy, and the investor that time they preferred to invest in the USA, not in the Indian economy. So we observed more outflow of capital. If you keep this policy rate same, then you are facing the outflow of capital from India. And outflow means they are also investing in our bond market, and also they'll investing in the capital market like equity shares. Okay, they are investing already. So they started selling out and they are going, they started leaving the Indian economy. So the demand drastically declined. Okay, drastically declined. So what's happened? Okay, that's a, again the RBI, because India also is starting facing the inflationary pressure. So RBI again in the parity of the world, we can say that, because if you read, then the whole world is facing the inflationary pressure. So we also started changing our policy rates, and then we have started increasing policy rates because overall the rate of interest may should go up in the economy. So when we started increasing, then we are able to stabilize the outflow of foreign capital. But when you start increasing the policy rates, the all rate of interest is going up. So as far as bond market is concerned, if suppose government is borrowing they want to borrow from the market, then you can just imagine that really you are going to buy bonds if suppose government is giving you the same old one 5.5% rate of interest. No. So even government has to offer the higher rate of interest on the bonds, then only the people are going, or any economic agent, they are going to buy the government bonds. So yes, the rate of interest offered by the governments on the bond, they have to increase it to bring the parity of the market return. So that way it's uh, affecting these things. ठीक है Siladitya? Okay, Partha, you are asking, sir, can you explain briefly the impact of inflation of our import and export? Simply, Partha, just you take a simple example, dear. I think you people are not following exactly the way I am just doing in the class. I requested you just follow in that way. Really, you can well understand. and very easy way you can understand it. So suppose any person, any foreigner, suppose you take this example. If they are coming with $1 in India and they are getting say 60 rupees, and suppose exchange rate is remaining same, price level is say rupees 10. So when 10 is the price level in the country, so this foreigner is coming with $1, and at this price level they are able to buy 6 units. But suppose exchange rate remaining same, because I requested in the first class, first 1 to class, dear, in economics when we are trying to relate with two variables, we are assuming other variables remaining same. So let us consider exchange rate remaining same and you allow only the inflations. So suppose inflation means, as I discussed, it is the process of increase in the price level. So suppose price level increase from 10 to 20. Okay. So once the price level has increased, so price level I discussed, it is a macroeconomic variables. Okay. So if price level increase means, okay, at the same exchange rate, if a foreigner is coming, so they can only buy 3 units of goods and services. So for the foreigners, our domestically produced goods and services becomes more expensive. And if it becomes expensive, then finally they will demand less, and their demand is our exports. So finally, exports of the country is going to increase. Clear? Now you assume here, you are the domestic one. Suppose you are the domestic one, domestic consumers and producers. You have options. You can demand domestic goods, or you have options to demand imported goods. Clear? Due to inflation, what is happening? Your domestic goods becomes more expensive. If your domestic goods become more expensive, then what is the options? What you are going to do as a rational consumer? You are going to just shift from domestic to imported, because imported goods becomes relatively inexpensive, and once you shift it, then finally the demand for imported goods will go up, means the imports of the country will, it's not this sign, I'm wrong sign. Exports is going to decrease and imports is going to increase. Change the sign, all of you, because due to that exports is going to decrease but imports is going to increase. And again, it's going to affect your, and if this is happen, then what will happen? Aggregate demand discussed in the class, which is equal to C plus X minus M. You remember? If X is going to decrease, M is going to increase, so ultimately aggregate demand is going to fall. And fall in aggregate demand leads to fall in output, employment, etc. Clear to all? Partha? So, sir, can you define again? See, value chain system, it means value chain system, you can understand it, different stages you are adding some value. So again, you take from the same inputs to the consumers at these points. What are the value additions? Okay, what are the value additions you are doing? That is the value chain system, and which is also linked with the supply chain system, because value addition is doing if it is going to be success if the supply chain is developed. But supply chain is the related to the input to the consumer. It's true. Okay. Okay. It is there. So you can add it, value chain system. Yes, you are adding different value, and if you take in the other way, so it's a very interchangeably we are using the word supply chain or value addition chain. So when you develop the value addition chain, means the supply things is connected, then only you are going to realize it. Okay, Biswajit, and Nahi, Subham, just like I am telling, like does not mean exactly banks. Subham, you are asking, sir, you said NBFC like banks. No, no, and why I told you the like banks, you understand one thing, you written that. See, if you're purely it is a bank, please don't confuse in this way. There is a word like, it means it implies, and what is not implied, just get it this. NBFC simply, and we had just discussed, NBFC is the existence is through the Company Act. Clear? Company Act, you have to register. But purely if you are just registering as a bank, then this banking registrations, you have to get it from the RBI. Difference between bank and the companies, NBFC, is that banks are accepting the demand deposits. Banks have to fulfill all the requirement like CRR, SLR, their facility to get loan from the RBI. These all are there what I discussed. NBFCs like bank, it means that they are some characteristics I am telling you, which is looks very similar. Like NBFC is also lending to the customers, but NBFC accepting, but in the FD, fixed deposit they can accept, or they can collect it money from the different schemes, but they can't accept the demand deposits. They can't accept demand deposit means if you're depositing, but when you want, you can get it 24/7, it is available, which is only possible through banks, not with the NBFC. Clear? So many things are not, that is a banks, it's there, but you can't get in the NBFC. So don't take the meaning of like. NBFC are like banks means some characteristics, some functioning of bank is same as the NBFC, but not the all function of bank is the same as the NBFC. And when you take the existence, NBFC's existence is through the Companies Act. But if you take the existence of bank, it is through the RBI. You have to take license from the RBI for doing the banking business. Second, what is ramification of KSEBD of India? See dear, generally in the economy now there are some curves, we are just using it, and let me just tell you, because only few things left, so that my target is to complete today. Okay, but since these questions you are raising, so let me just clear this first. There are some curve which we are used in the Indian economy. One of thing is the V-shaped curve. V-shaped curve. It's clearly 2 years back. If you go to the Indian the economic survey, the V-shaped curve is discussed. V-shaped means you understand that economy was at the higher growth rate, they come to the negative growth rate, and again started recovery. So that growth rate, this way of the development or growth you are observing in the Indian economy, which is known as the V-shaped growth rate. Okay, earlier, before pandemic, you can take the growth rate on an average in India, it was 7% or more than 7%. But during this period, the growth rate declined to the negative, minus, it was more than 7%, 7.2 around, minus 7.2 around. Okay, so you reach to the negative growth rate, and after improving in the economy, your growth rate has also started improving. So it is known as the V-shaped growth in the economy. Simple. Why economy faced the downward? Because you are knowing, due to the COVID forced lockdown, there was drastic fall in aggregate demand, drastic fall in the investment in the country. People got unemployed. The consumption and the investment declined drastically during this period. Definitely it is going to decrease your aggregate demand. And fall in aggregate demand, fall in output, and you observe the negative growth rate. When economy started improving after the pandemic one, okay, then slowly the aggregate demand started increasing through increase in consumption. Some sectors like the government and others, the private, they started coming, and they started investing in the country. Government initiative was much more during this period. So investment keeps increasing. Then finally aggregate demand started improving. An increase in aggregate demand shows the increase in output, employment, and we are registered the higher economic growth, and now we are just again reaching to that point. So coming here and then negative, then again going up, V-shaped. K-shaped means, just you take K-shaped means, take this point, you just make K like this, you take the midpoint. one diagram you take like upward and one diagram you take like downward. This is the K. So what is the importance of this K in the Indian economy? So importance of K is what? Ki some sectors in the country during this period you can take just excelled better, and they perform better. But some sectors in the Indian economy has declined, faced the recessionary effect. Why? Because due to this pandemic and after that period, the sector's demand declined drastically. So it started decreasing. And why started decreasing? Because remember, it's a domestic demand as well as international market demand declined drastically. Even you take the services, the contact-based services demand declined, but contactless services demand has increased. In Indian economy, where we are supplying to the productive activities, so since overall world productive activities declined, so demand for these sectors, the output has declined. So we are facing the downward. Some sectors demand picked up. Take the example of medicines, pharmaceutical industries. Okay, here demand picked up, so it's growing. Now you started the improving the services sector also, because as the world economy is growing. So the solution of this K-shaped, K-shaped is that we have to find out the reasons, the lack of aggregate demand that's decreasing this sector, some of the sectors in the country. Once the domestically international market started improving, then demand will go up and these sectors will also face the increase. But these things happen. This is the concept of K-shaped. The economy is facing the K-shape. Second, one is the J-shape. It's a Cousins given the J-shape curve. It's a Cousins J-shape curve. So J-shape is what? J-shape generally it means suppose you are implementing any policy at this point, you implement it. So what will happen? After initial implementation of this one, the income, if you suppose J-shape is generally related to that, suppose you started developing in the country. So if development process will start in the country, growth is started in the country. So initially the inequality in the country will increase. So it is going to the worst conditions, minimum. Means the worst condition you are going. Because initially you can see also in the India, when we adopted the capitalist pattern of development, not the capitalist economy, capitalist pattern of development, the inequality started increasing. And which is, you are observing that among the neighboring nations, yes, India is one of the highest income inequality country. So yes, it is happening that, it's happening. It's a report 3-4 years back, you can just take it. So after that, if suppose it is there, so if your development keeps increasing, so other factors keeps going to change, and government measures, progressive taxation system, others, they are trying to bring towards more inequality. So then your economy will start improving. So the shape you are getting is the J-shaped curve. It's a Cousins given this J-shaped curve. So simply saying, if development process start, first inequality will increase, means going to the worst, and then it's started improving it. One curve we are talking about, I think we have discussed it, Phillips curve. Phillips curve we are talking about. If you take the inflation along vertical axis, inflation rate you can take along vertical axis, and unemployment along the horizontal axis, then it is going to give you this type of curve. Phillips curve. Original I am telling you because in the so many books they are just making like this one, but no, because if you take the W Phillips, it's a Phillips curve. It is known as the Phillips curve. Phillips curve. So Phillips curve, if you take, then this point is known as U star. U star is known as the natural rate of unemployment. It's the natural rate of unemployment. Means this type of unemployment remain in the country even the economy is at the full employment. Full employment means the people who are willing to work, they all are getting the job. But there is some section of society, they don't prefer to work. So these people consider as the natural rate of unemployment. Suppose it's a natural rate of unemployment is there. So what is the logic? They say that ki inflation and unemployment are inversely related. Suppose economy is facing this much rate of unemployment, OU star. If your inflation rate is this much, suppose this much inflation rate, say pi 1 say inflation rate, so unemployment will be U1. So pi represents inflation rate. Pi represents inflation rate. Inflation rate. If pi 1 is the inflation rate, the unemployment is U1. If inflation rate is going to be pi 2, then at this inflation rate, now unemployment is U2, means lower than this. So inflation is going up, unemployment is going to decrease. Okay. So there is an inverse relationship between the unemployment and inflations. Yes, there is inverse relationship between the rate of unemployment and inflations. Okay. Logic is what? Logic is what? If there is a more inflations, so higher inflation is going to increase the wage rate. Higher inflation is going to increase the wage rate. So earlier the person who was employed, because suppose they are eligible but they were not willing to work because they're thinking that wage rate is very low. So keeping in mind the wage rate is very low, so they don't prefer to work. Once inflation is started increasing and the money wage rate, due to that it started, money wage rate, not the real wage rate, money wage rate started increasing. So these people will think now wages have increased in the country, or wage rate has increased in the country. So keeping in mind, they will come to the market, job market, and if they are coming in the job market, the unemployment is going to decrease. Again, inflation is going to be higher. Again, the wage rate keeps increasing much more. So more people will come in the market, means unemployment rate keeps decreasing. So this way it is there. So and this is the for short term. Remember, this is for the short term. This is for the short term. Short term only possible, there is a inverse relationship between the unemployment and inflation. In short term only possible the trade-off between unemployment and inflations. But when you are going for the long term, this relationship will not exist. Phillips curve will be parallel to vertical axis. Why? Because you are thinking now, yes, higher wage rate I am getting. And keep in your mind you are coming in the job market. But after few months, maybe 6 months, 7 months, 8 months, you realize, no. Money wage is higher, but inflation is higher. So my real wage is low. So the moment you are going to realize the real wage rate is still low, because higher money wage rate is due to inflation. So again, you don't prefer to work and you come back at the unemployed status. So in the long term, there is no trade-off you are getting, but the parallel, the line you are getting. So that is the reason you are saying कि long run Phillips curve is the parallel to vertical axis, no trade-off. Only short term you can get the relationship between the unemployment and inflation. Just get it here. Clear? That is we are talking about Phillips curve. Clear? And one more curve I am making it, remember, yeah, same diagram I prefer, because so that you can get it. Here is the tax rate. Here you can measure the tax collection, or you can say tax revenue. You can say tax revenue, you can say. Okay, so what is that? Its shape, its origin, it's look like this. So it simply says that if you just keep increasing tax rate, suppose T1, suppose T2, so your tax collection keeps increasing. But when you're reaching here maximum, say T star tax rate, so suppose tax collection is maximum. But again, if you think, keeps increasing tax, I am able to increase tax collections. No, dear. If from maximum, if you're increasing tax rate, then tax collection is going to decrease. Suppose you charge around T3, so tax is going to decrease, tax collection. So basically, this portion is good. So only problem is this portion, downward portion. So you are saying that higher the tax rate, lower the tax collections, and lower the tax rate, higher the tax collection. So yes, there is a negative relationship between this. So if you cut down the tax rate, you bring at the lower level, then tax collection is going to be higher one. And it is known as Laffer curve. It is known as a Laffer curve. But you have to think, because it's starting from the 0, 1, 0, 1. So after this point, maximum tax rate, you can take T star, which your economy can tolerate, and where you are just getting the highest amount of tax collections. From there, you can compare it. So Laffer curve, it is known as the Laffer curve. Laffer curve. Okay. So V-shaped, K-shaped, Laffer curve, J curve, J-shaped curve, J-shaped curve. Cousins given this. Cousins curve. Cousins curve. And it is the Phillips curve. So yes, these are the things we are using in the economy. Check dear, clear? Subham, you are clear? And what is the ramification of K-shaped? Valiola, clear here? So the problem for us, these industries not, it keeps increasing. We have to think about this portion, these industries. That industry is really affected much more. So we have to take a strategy and we have to recover it. And since these industries are also due to the problem in international market, so we have to improve our presence more in international market. Now think dear, any doubts, any questions you have, then please tell me. Okay dear. Clear? Now, one more things in this market, let's discuss with. One is the ADR, GDR, and IDR. So ADR, GDR, and IDR, these are the, what is ADR? American Depository Receipts, ADR means, and GDR means Global Depository Receipts, and IDR means Indian Depository Receipts. So please get the concept behind this. So suppose you take, it's a Indian economy. You take Indian economy. You take the example. And in Indian economy, suppose there are so many units are there, producing units are there. So many producing units are there. Really, these units having more potential to prove, more potential to grow and develop. Okay, they have the potentials, but they need fund. That need the fund. Suppose you take the example of, here is the USA. You take, it is the example of USA. So these units, these companies, suppose they are registered, everything is fine, but these industries or these units are not known in the USA, but they want the foreign capital, they want to collect the foreign capital from the world or from the other in the countries. They prefer, international investors should invest. Other options are there, but one of the option is that if they are issuing the equities, or shares, okay, if they are directly going and is selling in the USA, maybe no one is going to buy this. Maybe. Because generally we prefer to buy the equities or shares to those companies I am knowing about their performance and these companies are known to me. So first of all, you are getting this information, keywords about these companies. Okay. See, you take the example of Amazon. If you are buying anything from this website, even you don't know the company when you are buying these things, but you are buying this. Why? Because one brand name is carrying with this particular seller. Amazon is giving you safety and security about the product. If something will happen, then I will take the responsibility. And that safety and security which is given by the Amazon is giving one incentive to go and buy that product, and you are buying that. Same concept, why not you bring it here? If suppose in Indian economy, so many different units are there, they are working in the Indian economy, but they want fund from the international market. If they are going to international market, they are on. And if they want to borrow from these economies, from the stock market, from the economy, not from the bank, okay, from the public, if they want to get the fund, maybe they are not getting the fund. So what is the other system? In our Indian economy, there may be any depository. There may be a depository. Depository means any institution, but the depository must get the license from the SEBI. If SEBI licensed this institution or maybe any financial institutions, yes, you can act as a depository. So what the institution they can do that, they can just keep equity and shares of different companies. They can keep in their depository. What they can keep? Equity or shares, you can say. Equity, shares, and other financial products. They can keep this in there. And how much they are keeping as a depository? There is a worth, there is a value of this depository, how much the worth of equity and shares they are holding. And this company, either they can make a tie with any other international institutions. Suppose some international institution or the institution which is established in the USA, they can tie up with this institution. They can tie up these institutions, or they can directly sell in the USA. Both is possible. Suppose even this institution is not known to this in this economy, so they can tie up with the other institution, and through this they can issue a receipt. Receipts what? Receipts of the depository they kept in India. They are going to issue a receipts in the USA. The receipts is against the depository that kept with this, I mean, they're kept by this institution. So against this depository, they can issue a receipt. That is the thing. If this receipt is issued in the USA, so it is known as American Depository Receipt, means ADR. ADR. Or in any other country, then it is known as a GDR, Global Depository Receipts. This is the normal concept. And if the same things, other international institutions, if they are doing in Indian economy, suppose they kept their depository of equity and shares in their own country, suppose in the USA, and they are issuing a receipts to my country, that is a depository receipts, that is known as a depository receipts. Depository receipts. If they are issuing it in India, then it is known as the IDR. IDR. Simple. Check dear. So concept is clear. IDR, GDR and ADR. Okay, please write few lines. Right. A depository receipt is a, please write all of you. A depository receipt is a financial instrument representing certain securities like shares, equities, etc. issued by a company in a foreign jurisdiction. Okay, full stop, right? Securities of a firm are deposited with a domestic custodian. This depository is known as the custodian. Custodian means you are keeping in your custody. Here, custodian, domestic custodian in the firms, oblique companies, domestic jurisdiction. In the firms, oblique companies, domestic jurisdiction. Within your country, domestic jurisdictions. And a corresponding depository receipt is issued abroad, which can be traded. Just write is issued abroad, and a corresponding deposit receipt is issued abroad, which can be purchased by, right, like this, which can be purchased by foreign investors. Yeah, after is issued abroad, we can write which can be purchased by foreign investors. Full stop, right? Depository receipts is a negotiable security, which means transferable. Depository receipts is a negotiable security, which means transferable, okay, comma, that can be traded on the stock exchange, if so desired as per the rule and regulations, Just you get one thing dear here. What is the benefits of the Indian companies if they are issuing the GDR or ADR? Simple. If they are issuing their depository receipts in USA, it is known as the ADR. And if they're issuing in the other countries, then it is known as a GDR, Global Deposit Receipts. If they are doing same thing with in India, it is known as the IDR. So it is a mechanism through which the Indian corporates are getting the foreign capital, and they're using the foreign capital for investing in their plant. So it's helping to the Indian corporates through ADR and GDR, and also the foreign investors through this they are getting opportunity to invest in other countries like India. Yeah, they are getting the opportunity to invest in India. And one more thing for the investors are more convenient, investors are more, comfortable in ADR GDR way, because this ADR and GDR issued in that concerned state, issued, I am telling you, not the depository, it is at the home country. Depository which is issued in that particular country, these are all governed by their domestic economy. If it is issued, ADR issued in the USA, so ADR are governed under the USA rules and regulations. So it's good for the investors that they are investing in the domestic country and they govern in the domestic country. So, but they are getting the benefits of other growing nations. So it's a very good way, good instruments for the foreign investors to invest in this and get the benefits of higher growing economy like India. Okay. Okay. Please write few lines. Right. Deposit receipts constitute an important mechanism through which issuer which issuers means the companies who issue it, issuers can raise funds. Issuers you write, or oblique you can write companies. Raise funds outside their home jurisdiction. Okay, home jurisdictions. Full stop, right? DR are issued for tapping foreign investors who otherwise may not be able to participate directly in the domestic market. Okay, full stop, right? For investors, comma, depository receipts is a way of diversifying the risk. For investors, comma, depository receipt is a way of diversifying the risk by getting exposure to a foreign market without the exchange rate risk. Why? Because you are investing in India, in USA, in ADR, a return you are getting in your home currency. So you are not getting problem of exchange rate risk, because in other case, suppose you are coming in India and investing. So fluctuation of exchange rate in India may put another risk to you. So it's a good thing, you invested in dollar, you're getting the returns in the dollar. So you are not getting the problem of exchange rate, which are the problem which is there. Okay. So without the exchange rate risk, as they are foreign currency denominated, full stop, right? They feel more safe they feel more safe to invest from their home country, from their home country, from their home country. Okay, full stop, right? Depending on the location, depending on the location where these receipts are issued, where these receipts are issued, full stop, right? If they are issued in, if they are issued in USA, USA, USA on the basis of, on the basis of the shares oblique securities, shares oblique securities of the domestic company, of the domestic company, say Indian companies, domestic companies, say Indian companies, say Indian companies, they are known as, they are known as, or it is known as ADR, 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 American Depository Receipts, ADR. Clear? Full stop, right? IDR or Indian Depository Receipts, after full stop, right? IDR, that is Indian Depository Receipts, if they are, if they are issued in India, if they are issued in India, if they are issued in India on the basis of, on the basis of the shares oblique securities, shares oblique securities of the foreign company, issued in India on the basis of the shares oblique securities of the foreign country, foreign company, of the foreign company. Okay, full stop, right? In general means suppose Indian company issued in other companies. In general, it is known as GDR, Global Depository Receipts. In general, it is known as GDR, Global Depository Receipts. Write one more line, change the para, right? Thus, THU, thus ADR or GDR, ADR or GDR issued outside India, issued outside India, issued outside India by a foreign depository, by a foreign depository. Just as I told you, na, you can make the entity or agreement with the other depository or any entities here, or you are known in the world, suppose you are doing that, you can do that. So depository, foreign depository outside India by a foreign depository, foreign institution, you can say foreign depository, on the back of, on the back of, on the back of an Indian securities, on the back of Indian securities, not an like, on the back of Indian securities, deposited with a, deposited with a domestic, domestic Indian custodian, domestic, domestic Indian custodian. You have to domestic Indian, domestic Indian custodian in India, in India means a custodian or keeper of securities, a custodian or keeper of securities. It may be an Indian depository, it may be an Indian depository or a bank, or a bank, or a bank and having permission from this and having the permission from the SEBI can act as a custodian, can act as a custodian, can act as custodian. Clear, dear? Yes, dear. This part is over. Now you can check. If you have any problems, then you please tell me. Okay. Please, few lines if you write about, please, till here is clear to all. Now let me check your doubts or questions. Yeah, sir, please explain how RBI is selling of long-term bond in market leads to reduction in interest rate of banks in long-term loans, Partha. No, Partha. See, generally RBI is not. If suppose RBI means what? It's a government securities. It's a government securities. Okay, and government securities, suppose RBI is selling at the low rate of interest, because the long term, if they are selling at the lower, issuing in the behalf of government of India at low rate of interest. So what indication is going to the nations? Yes, in the long term, the RBI is going to decrease the rate of interest, because you have to bring the parity in the future, in the long term. If you are doing that, then it's giving one of the indications to the banks to maintain in the future RBI is going to bring down the rate of interest. So just one of the indicators in this way you are taking. Okay. And when you said why in Laffer curve when increased tax rate but tax collection is decreasing, then this is very simple, dear. Let us consider you are earning 1 crore rupee and government is saying, okay, give me around flat, you can give me them just like the 50 lakh rupees because you earn. Suppose high progressiveness is there. So I'm not going the slab by, suppose 5% for this amount, 10% for this amount, 20% for this amount, 30% for this. I'm not going in this step wise, I mean slab wise. Just you assume that flat for understanding, Okay, 50% I need to pay to the IT department, 50 lakh rupees. So if suppose your CA is asking you, sir, give me 5 lakh rupees to me, I can manage it and I will make it the tax around 10 lakhs. So you are going to get the benefits. So you will think, okay, 10 lakh rupees I am going to the giving to the government, so government is also happy, and CA is going to manipulate my account, so 5 lakhs rupees only they are charging. So I'm going to pay only 15 lakh rupees, is it? And save, I'm going to just save my money around 35 lakh rupees. Fine. So since you are saving the 35 lakh rupees, you prefer to go and ask CA, go ahead. So what's happened? Government's collection has declined. Government's only able to get 10 lakh rupees. But suppose government is just charging the 20 lakh rupees when you earn the 1 crores. So then you will compare, oh, if I'm going through the illegal way, I'm giving to the CA 5 lakh rupees and 10 lakh rupees to the government. So finally I'm paying the 15 lakh rupees. If government I'm paying is 20 lakh rupees, so why not I will pay it? 20 lakh rupees is fine. Why? If suppose even I am just able to sell 5 lakh rupees, but it will create some problem to me in future. Always I will be in the some threat, anything it will happen. But since it was the matter of 35 lakhs, I was able to sell earlier, so I can take the risk. But it's a matter of only 5 lakhs, why I will take the risk? Better, I will not pay to CA, I will pay to the 20 lakh rupees to the government. So government now getting the 20 lakh rupees as a tax collection, but earlier due to the high tax was only getting the 10 lakh rupees. So it means if government is charging the moderate tax rates or lower tax rates, they may improve your tax collection. And that's if you take the Chilaiya committee recommendation, if you take the Vijay Kelkar committee recommendation, they all recommended cut down in the personal tax and the other taxes. And then we started decreasing that. Comfortable. Now you can just take this recent example, government has announced it till 7 lakh rupees, you don't need to pay any taxes. So basically it's a relief to the the low income group earners, because at least that much amount you are going to use. That's earlier you used to pay when 5 lakh rupees with the, slab minimum one. But 2 lakh rupees extra you are earning, but you are not paying any tax to the government, which is going to help you to maintain your consumption and other welfare things, personal one. Okay, this is the way, Chandan. Clear here? Okay, sir, those foreign companies which are already listed on Indian Stock Exchange, can they also use deposit receipts? See, you are listed, fine, but you have to deposit to the depositories. There must be depositories. Okay, they have to get license to do this work. Okay, they must act as a custodian. So deposit, you are not issuing directly to the public, you are giving this your equity in shares to that particular company, and against their depository they are issuing the receipts. This is the way to working. And in the domestic stock exchange, if you sell your equity shares, you are getting in terms of rupee, but if your depository DR is issued in other countries, you are getting in terms of foreign currency. So which will meet you that both the requirements, capital, but also since it is a foreign capital, so you can buy the foreign machineries and you can pay you can get other equipments and the technologies from the other countries. For that you need the foreign currency there. Second, sir, through this foreign investors are indirectly investing in Indian companies. So then citizens of Pakistan, Bangladesh and China are also allowed through this. And see, as I already discussed, there is no issue in the foreign portfolio investments, and these all are the financial assets. You understand? Already I discussed with you. So these are the financial assets. If you're investing or any country investing in this, it's come under the category of foreign portfolio investments. And as such, there is no restrictions in the foreign portfolio investments. They can invest. The only restrictions we imposed in the FDI. So the policy what government of India changed, it is the FDI policy. Remember, okay, we just added one more word, that is any country which is linked with the India land border. For them we made it the government route, but we are not denied you can't invest, but you can come, you can invest, but through the government route. So I can check where you are coming. Few sectors only, dear, don't take another way, only few sectors like atomic energy, defense, okay, defense and space. These sectors only we prohibited for the Pakistan, not with the other countries. Even Bangladesh is allowed, even China is allowed. So take it, you don't include all these countries from this because you're going to be diplomats also. Suppose in UPSC you're getting the Indian Foreign Services, you will be placed in the Pakistan also, Bangladesh also. So how to speak, how to write and what to say, we have to know, dear. Okay. So it's a very categorically, it's a mention that is the reason we adopted the policy that is a land border connected. Okay. Land border linked. Okay, Nyan. Fine, sir. From which route these foreign funds will come to India if an Indian company or Indian bank issue DR? See, already I discussed with you, dear. You see, after the Tarapur committee, so many recommendation was, Tarapur committee recommended so many conditions they imposed. If we are able to fulfill these conditions, then we can go for the capital account convertibility. But India not allowed full capital account convertibility. But yes, like FPI, we allowed the capital account convertibility. It means they can come. Capital account convertibility, I discussed this concept in the class, where you don't need to take permissions, dear. You don't need to take permissions. Okay, you can just, you are exchanging the foreign currency to domestic currency to foreign currency at market determined exchange rate. Okay, at market determined exchange rate. So, and no authority is going to intervene in that. So you are getting it, you are exchanging it. So again, you are asking me, it means already you are allowed. Convertibility is allowed means you are allowed. The government is not going to intervene. Clear, dear? Okay. Okay, Om? Please connect, dear. Please, I am requesting all of you. The content, the concept, the framework, why I developed it, what we developed with you, it's really very enriched one. You read several times, you are going to get so many things. And I promise you at this platform, if you're able to understand my class, you already understood my class, and if you're able to understand all the notes what you made in the class, okay, like I discussed it, I dictated to you, go through this. If you are going to command on this, I promise you, You are going to understand, and clearly I am telling you, to each and every incident, each and every sectors within the domestic economy, between the Indian economy and the rest of the world, you can better explain this. That part is your. Okay, thank you, dear. Okay. So now you write few lines about the just concept. Now I'm going to give you, because where I am feeling, you need some analysis and the conceptual clarity. Definitely I will give you, but we are in few lines. If you think, there's only I will give you information. Thank you. Okay, please write all of you. That's about stock exchange, right here. Just give a stock exchange the concept. Right. Two lines you write. A stock exchange is a company. A stock exchange is a company that provides a trading platform for stocks. Stocks means you can say equity, shares, all the finance assets you can take it. Right. Investors purchase and sell shares and other financial instruments. Investors purchase and sell shares and other financial instruments in a wide range of listed firms through stock brokers on a stock markets, right? Stock market trade not just shares oblique equities, but also mutual funds, debentures, comma, government securities, and other financial instruments, Clear here? Okay. Now, please write. Okay, right. Stock exchange is divided into, and stock exchange is also known as the capital market. It is a comes under capital market. Okay. So you can write stock exchange oblique capital market is divided into two markets. First you write primary market, and second one you write secondary market. Primary market and second one write secondary market. Right, primary market you write one line. The primary market is the component of the capital market. The primary market is the component of the capital markets that deals with a company's direct issue of new shares oblique equities to investors through an initial public offerings right in the bracket IPO. Okay, IPO, short form is the IPO, initial public offerings, full stop, right? It is called, okay, right, when a publicly traded company means you are listed by the SEBI, and then you can allow it, and sometime not, but you allowed privately, you can allow. Okay, just write, when a publicly traded company needs to acquire funds, it may choose to issue equity oblique shares, in which current shareholders, in which current shareholders are initially given, more shares, more shares at a low price, at a low price. Okay, full stop. And depending on the current shareholders, if they want to accept, they never accept, otherwise they will refuse, it. Now write the secondary market. So always remember, write one line, कि primary market means primary market of capital market. Remember, primary market of capital market means transaction between company and investors. Transaction between, or you can say under the primary markets of capital market, transaction takes place between the company and investors, Okay, now second you write the secondary market, right? The secondary market is a capital market, for trading securities, oblique equity shares, that have previously been issued, as IPO, as an IPO, full stop, right? Full stop, right? In this market, means you are talking about secondary market. In this market, the seller of security is investor, and buyer of security, write it, and the buyer of security is also investor, full stop, right? Therefore, under secondary market of capital market, transactions takes place between the investors, Why? Because initially in the primary markets, the person who purchased, they are the investors. So transaction was between the company and the investors. So once investors purchased, and later on again this existing shares or government or securities, it may be private and government, again the transaction is going on. I mean, definitely between the investors and investors, but among the investors you can say, or between the investors. Clear to all? Okay. Now, so please, I just discuss with you. I'm discussing. Please read yourself. It's a very normal information you can get. The different stock exchanges in India, like you just write. Okay, first you write, and please get it in the detail of this. Right. There are the stock exchanges in the country, Like one you write Bombay Stock Exchange. BSE, it is known, Bombay Stock Exchange. Second you write National Stock Exchange, that is NSE. Next, United Stock Exchange. Okay, it's in the country, right? Next, Metropolitan Stock Exchange of India, MSE. Metropolitan Stock Exchange of India. And next one you write India International Exchange, INX. India International Exchange, INX. Clear? And please, I request all of you, please go to their, all the stock exchange has their own website. Get it, read from there the introduction. You can get so many things, but in the so micro level don't go, because in this exam, particularly in UPSC, they only focus on the policy, how this is working, how it's going to that. But micro level information you need in this market. if you are going to do the trading business, you are going to the trading business in the stock exchange like this. So don't go in that much of the information. That's really we don't need for the commission exam. But yes, sometimes they can give you, okay, these are the stock exchange or not, or they can ask you some things they can ask related to that. So only minor information we need for the PT purpose. But if you think for the mains, you don't need to go it. But yes, the role of capital market, if any, who is regulating, what are the changes they made, how the government is going to change the policy. So the policy matter, you have to just focus on that, all the new changes. Clear to all? Okay. So please go to the each and everything. And Sensex is again, the Sensex word you write it, because Sensex generally we are confused. Okay, what is the meaning of Sensex? So just write few lines. Sensex, right? The Sensex, the term Sensex is a combination of the terms, sensitive and index, sensitive and index. Okay, right. The S&P means Standard and Poor's, the S&P, BSE, Sensex. S&P always write in this format like S and P. Okay, right. S&P, BSE Sensex, has been based, has a not has a base period, on the basis of that, index are formed. So Sensex, you can see basically you take the different equity and shares, what you choose in each and every the stock exchange, they are making their own Sensex. So they will choose the prices of the prevailing market prices of the stocks they selected, and they will make an index, and that index is known as the Sensex. So sometimes you're saying that Sensex has increased. When it's going to increase? When demand is more for the particular, in that market the stocks demand is more. So prices, if demand is more, so price will go up. So Sensex keeps increasing. If demand declined drastically, so price of that stocks which is they selected, okay, for on the basis of that they made the Sensex, that is going to decrease. So in this way we are just saying that yes, it's a more sensitive or not. Okay, that things you understand clearly. Okay, now just you write same thing about the SEBI. SEBI, we already, I'm just giving you the brief one, so you should aware about that, so that you can go and just see. SEBI, their own website is there, so introductions, composition, who at the present, what they can do, what are the notification. Please, when you're getting time, but don't go in the very detailed one. That's only I request. Okay, if any changes in the policy of the government, that part you have to focus on that for the exams. Okay, not at the micro level, just you write few lines. SEBI, or just given the SEBI, the capital market, right? The capital market in India, are regulated by the Securities and Exchange Board of India, SEBI, Board of India. Like in the money market or the banks and others, the head is the RBI, but in the capital market, supreme is the SEBI. SEBI regulates. Okay, stop. So Securities and Exchange Board of India, SEBI, full stop, right? It was established in 1988. Okay, 1988. Okay, full stop, right? In 1988, and given a statutory right like this, and given a more power in 1992, through a parliamentary act, SEBI Parliamentary Act, SEBI 1992, SEBI Act 1992, SEBI Act 1992. So you understand that when in 1988, when it was constituted, there was no recognition by the parliament. It's made a SEBI board, and that's were allowed to function. But so many things started happening in this. So Parliament wanted to give the statutory power to the SEBI. So they come out with the SEBI Act in 92 and they give in the power. So now Parliament authorized now SEBI to act on that. So they have the power, just like the RBI Act 1934. And it is the SEBI Act 1992 is passed by the Parliament, given the statutory power to the SEBI. Right, few lines. SEBI regulates the working of stock exchanges. SEBI regulates the working of stock exchanges and intermediaries such as stockbrokers, approval of mutual funds and other funds, registration of institutional investors and individual investors, institutional foreign investors and individual foreign investors who are willing to trade in Indian stocks. Okay, full stop, right? SEBI Act says that it is the duty of the board to protect the interests of investors in securities. Okay, full stop, right? SEBI promotes investors education and training of intermediaries of securities markets, like brokers, credit rating agencies, okay, etc. SEBI prohibits unfair and fraudulent. Okay, just you write the SEBI prohibits the unfair trade practices. SEBI prohibits the unfair trade practices. Clear here? So please, you should remember these things. Now, just some other concepts you write. Like derivatives. So what is derivatives? It means derivative means something you kept, and on the basis of the value of this you derived the other value, or derive the some things. Suppose equity shares you are issuing, but on the basis of some value or assets you kept it. So against that assets you are deriving some value. So that is known as the derivative. Suppose I kept some assets. So I am not issuing these assets directly, but against this I am issuing something. That is known as the derivative. This concept is there. Please write few lines. Right, derivatives. It derives from an underlying assets. Like securities, shares, debt instruments, commodities, etc. Right. The price of the derivative is directly dependent upon the value of the underlying assets in the present and the projected future, projected future trends, projected future trends. Right, futures, F-U-T-U-R-E-S, futures and options are are the two classes of derivatives. Futures and options are two classes of derivatives. Okay. Futures and options are two classes of derivatives. Just write few lines. Futures are financial instruments. Futures are financial instruments. Based on a physical underlying full stop, right? A futures contract is an agreement. A futures contract is an agreement between two parties. A future contract is an agreement between two parties to buy or sell an asset at a certain time in the future for a certain price for which a small part of payment has been paid at the time of signing the contract. Clear to all? Now, just you write one, change the paragraph, right? Futures are different from no, don't write this line. Just change the paragraph, write only one line. Options are a class of futures, like in this way. Okay, right. Options are a class of futures where the buyer or seller has the option whether to buy or not. This is the difference, dear. So it is the derivatives. Suppose you kept some assets, against that you derived some value. Maybe you derive some value and you are now selling it. So you make a contract. So derivatives may be futures, or it is known as the futures, or it is known as the options. In future, you have to buy. That agreement you made it. But in options, if you're going for the option, then in the future, you may buy or may not buy. The seller, they may sell you or they may not be. So this is known as the options. Clear? Just you add one more line. Put option is the right but not the obligations to sell. Put options. If suppose you are in options, you are betting the put option. Put option. So put option is the right. Yes, you can sell, but it's not obligation you have to sell it. So buyer has to buy it. So what you are buying is depending on put means you have a right to sell, but it's not obligation you have to sell it. So if I want, I can sell it, but I want to decline, I can decline it. So this is known as a put option. So put option means it is a right to sellers, but it's not the obligations. Just write one line first. Put. Okay, put option is the right but not the obligations to sell. Put option is the right but not the obligation to sell. And CALL, call options. Another is the call option. So one you have seen put option, and one is the call option. Call option. Yeah. So what is call option? Just you write. Call option is right but not the obligation to buy. Yeah. It is from the buyer's point of view. If you just buying any options and it is a call options. So buyer has the right to buy it. But if they want, they can decline it. Call options, right? Call option is right but not the obligations to buy. Okay. Call option. Call option is right but not the obligations to buy. Clear, dear? Check all of you. These are clear. Yeah, there is a one, and you are saying about the commodity exchange. Yeah, commodity exchange market is also now it's a developing in India. Okay, just like the financial assets, you can also do the same transactions for the commodities. Okay, you can just use the commodities, and this you can use it in the stock exchange, but that is known as the commodity stocks, and which is now more demanding. So right, for just few things you write, right? Commodity exchanges are institutions. Commodity exchanges are institutions which provide a platform, okay, which provide a platform for trading, okay, which provide a platform for trading in commodity futures, like stock exchanges provide space for stock exchanges provide space for trading in equities. Okay, you are comparing with these two, right? They play a critical role in critical role in price discovery price discovery where several buyers and sellers interact and determine the most 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 reasonable price, that is market price for the product. Full stop, right? Indian commodity exchanges offer trading in commodity futures commodity futures in a number of commodities in a number of commodities in a number of commodities. Okay, the regulator is SEBI. Presently the regulator is SEBI is also is regulating this. Clear? So till this point you can get here. Okay, let me see. Okay, few questions you send me, but let me first complete few topics only, then I will just discuss with you. uh, NSDL you write what I discussed with you. Depository I discussed the custodians you write. National Security Depository Limited, NSDL, you heard about that. NSDL, okay, NSDL, right? National 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 Securities Securities Depository Limited. Just write only one line. In the depository system, because I discussed with you ADR and GDR, so related to that. In the depository system, securities are held in depository accounts. Securities are held in depository accounts, which is similar to holding funds in bank accounts. Which is similar to holding funds in bank accounts. Full stop, right? NSDL is the first depository in India. NSDL is the first depository in India. Depository in India. Okay, full stop. Means that is they are doing that. They are converting in the actual your assets or securities into the other things. So they can convert it. Okay. Let me some few things. And yeah, some terminology we are writing it. You can write share. You can write generally we are share and equities are both things you can just write, but write a few lines. SHARE, right? Share is a certificate. Two lines you write, not. So you should aware about that. SHARE. Share means share is a certificate. Share is a certificate representing ownership of the company. Representing ownership of the company. SHARE is a company that issued it. That issued it. Okay. Right. Shares can yield dividends. Shares can yield dividends and entitle the holder to vote and participate in decision making process. Shares are also known as stock or equity. Shares are also known as stock or equity. Full stop, right? If the company does, or if company performs well, there may be bonus shares issued to existing shareholders. Bonus share means bonus share I given you, more share I given you, bonus shares to existing shares if really they perform very good. Okay, bond already I just discussed with you. Debenture you write, debenture. Okay, derivatives I discussed with you. Debenture you write, debenture. Debenture is an unsecured. It is not. There is no collateral. It's unsecured. Okay, unsecured debt instrument. DBT, debt instrument. Unsecured debt instrument. Debt instrument. Okay, carrying interest. Full stop. It is a corporate financial instrument. It is a corporate financial instrument. Okay, instruments. Full stop, right? Debentures can be convertible debentures. Debentures can be convertible and non-convertible. Debentures may be convertible and non-convertible. Clear? Yeah, debenture two types, convertible and non-convertible. Line first, convertible debentures convertible debentures can be converted into equity, okay, at a future time, or future date. Suppose debenture is what you are getting, that is a unsecured the debt instrument. Suppose you borrowed from me, I given you, suppose. So, and you promised me the corporate sector, that is directly corporate sector, and they will definitely, they are giving to some certificate here, this much amount you invested in my company and I am promising to pay you this rate of interest. So yes, it is known as the debenture. But in future, if it is a convertible, so suppose you are performing soon, I will not ask you, you have to give me this much of interest, this principal. I can say, yes, you convert into the equity. Why equity? Because now I am going to share your profits. Okay. till your debenture is just like the initial stage. So you're liable to pay me principal and interest amount. But if I'm just converting it, then yes, I can share the profits. Non-convertible means you can't do that. Okay, just to write one more line. Non-convertible debentures will not be converted, will not be converted into equity oblique shares. Clear? Now, few words you should know. One is the beer. One is the beer. Yeah, one word we are using, the beer. Beer means you can see beer is moving like this. So, okay, so they're seeing it's the downward. So when it's seeing the downward, so it's a beer one means the persons who are also always think that okay, now share market is going to downward. So beer is the word we are using that okay, when you're expecting share market is going to downward. So just write beer is an investor. Beer, beer is an investor who believes that market will go down. Market will go down. That is a pessimist. That is a pessimist. Pessimist. The beer are the pessimist. So they are thinking that market will always go down. Okay. But other word, what you are using, bull. So you can just see that bull, you can see always like this, they are going that. And if they are putting it but always for the upward, just okay. So you can just see the bull when normal they are moving, always the standing form like this, but bear always in this four. So that you can take in that. So bull means okay, when you are expecting the share market will go for upward, so then you can say the investor is the bull investor, right? Bull is an investor, bull is an investor who believes that the market will go up. The market will go up. Bull is an investor who believes that the market will go up. An optimist. An optimist. An optimist. Okay. Similarly, you can use the word bull market. Bull market. It means here you are talking about the investor, but here talking about the whole market. When you're expecting market is going up, so you can say, okay, yeah, bull market, right? A stock market that is characterized by a stock market that is characterized by rising prices over a long period of time, rising prices over a long period of time. It represents a period of investor optimism. It represents over a long period of time. It represents time. Full stop. Just write full stop. Then you write it represents a period of investor optimism. Okay. Second is the blue chip. These words you are getting this. Okay. So always good quality of shares and equities you're talking about. Write one line. Blue chip shares are the shares of the companies. Blue chips. Blue chip shares are the shares of the companies. That are the most valuable companies. That are the most valuable. Full stop, right? Companies that are profit making. Companies that are profit making, dividend paying, and more liquidity in the markets. I mean, they have the enough capital, more liquidity in the markets. So these companies are known as the blue chip companies, and shares issued by that is known as the blue chip shares. You can say that, or blue chip shares, or blue chip you can say. Okay. Large cap, mid cap, or a small cap company. These are the word we are using. Large cap, mid cap, and small cap companies. Yeah, a small cap company. Okay, what is the basis you are defining? Just write one line. Right. Companies with a market capitalization. Market capitalization means the total amount of capital you are talking about, the value of equity and shares in the market. There's total capitalizations. Okay, companies with the market capitalizations that is very high, it is very high, are called large caps, large caps, and the next range below is mid cap, and the bottom one is a small cap companies. Bottom one is small cap companies. Full stop, right? Limits are not fixed by the competent authority. Limits are not fixed by the competent authority, but it vary from institutions to institutions. Okay, so it's not fixed, so we are not using this terminology. So yes, concept is that, but quantify it's very difficult one. Clear, dear? Okay. And few words remain. Just let me think. Is there any? Yeah, dear. Few questions have sent me. Let me answer this then. You understand this, what you are saying that, dear, okay, as my understanding, year after year, there is a motivated step is taken by increasing the price of tobacco products to curb the menace. Okay, but you understand first point, okay, government is keeps increasing every year the taxes on tobacco products, but tobacco is not the general product here, understand? Okay, tobacco is people are using as addicted product. So if the people are addicted for this, they will pay this. That is the lexicon preference. In economics, we are just lexicon preference. You are addicted with that. So whatever price the government is going to charge, or whatever taxes the government is imposing, that leads to increase in price, but people will still demand. People will demand. If they're habituated, they need it. So this type of product is perfect. You can say it's a more inelastic, and sometimes it's a perfectly inelastic. Whatever price you are going to impose, no, there is a demand. And even now, this things is going to be some sort of, in some societies, a matter of symbol one, status symbol one. If they are going to take this tobacco and other products, so their symbol, okay, I'm just taking this one, this brand, that brand. So again, if government charging, you are paying that. But when you're talking about the medicines, dear, Subhasri, medicine is it's a normal medicines means it's a very necessary medicine, but necessary in the different things. You are only going to demand when you need it. If there is a health issue, then you are demanding. If there is no health issue, you are not going to demand it. So when there is a health issue, then it becomes inelastic for you. Whatever the price in the market, you are going to demand. But who told you the government is not controlling this, the pharmaceutical sector? The government keeps controlling, dear. Most of your life-saving drugs, it is under control of the government. You can imagine that if government is not going to control it, the price of these products will be much higher, much higher, particularly your patented drugs. At least you can give the thanks to your generic medicines what we are producing. They are able to control the prices in Indian economy. And why India is performing more in pharmaceutical sector? Okay, and why we are performing better? Because the drugs what we are producing in India, most of the drugs, it is the nature of generic drugs. And if you go and buy the patented drugs, it's the very costly, it's the maybe 10 times, 20 times, or maybe 5 times you are paying the price for that. Jan Aushadhi Yojana of the government of India, what is that? The salt, it's in the medicines, more or less remain same. They are remaining same. Yes, but they are selling at the very low price. Same salt you can get it, but the low price. Why? Because government is trying to make it feasible to the normal common people. So government is doing that. Jan Aushadhi Yojana, you can take the example. Okay, you take the exam. Yeah, you go and ask this. There is a regulatory one. Government last, I think, just last 1 year, last one, it becomes 1 and 2 years. The government has regulated the price. They revised the price, and drastically there is a cut in the medicines prices. Drastically cut in the medicine prices. Government is regulating there. So in news, it says short selling of shares due to Adani Hindenburg controversy. It is profitable. What is it, sir? See, again, you have to just keep your mind at the higher directions, and people are going to demand your share. If suppose the share, sometimes, there is a Vavlin effect is also there. Sometimes it is a working, and sometimes I just remember I discussed with you given goods concept, but given goods concept exactly you can't take it, but you can take it sometimes. We feel that forget about the given goods, because otherwise again the inferior concept is going to just create some issue. Just take like the very simple one. Price is increasing and it keeps in our mind. The price increases, why? Because demand is more. The price is increasing and demand is more. Okay, due to that, so people start demanding. Okay, because suppose if demand is more, okay, then only price is going up. So if anything you can feel that ki price is increasing, then people can believe that your demand is more. So if you are thinking demand is more, then you will also prefer to buy this. Okay, so these are things going on. So it is one of the reason. And if you are selling the higher prices, means you are getting the higher return, higher amount, higher capital. So if your product price is not that and you are getting that much, so yes, you are making this profit. Just a minute. Okay, so yes, your worth is not, but you are selling at the higher price. Definitely, you are making more profit here. And second, you are saying, sir, can we say that same thing? I think you are asking, Subodh. Saladitya is just send me. Sometimes SEBI is it's happening because you are giving the documentary things, and on the documents, if everything's fine. So they may give you the chance. Okay, but today's very difficult to say on this platform, but it's true also that okay, the big corporates, and when there is a support of the government, so there is a possibility. Uh, okay, these things are possible one, because I mean the what you are talking about Hindenburg is this company basically is surface this all these things. They surfaced all the things, but not the from the government side. You understand? So yes, you can make this statement, Subodh, but I'm not going to discuss on this too much. Sir, explain dividend. Actually, dividend is nothing there. Dividend means कि suppose I purchased your share or equity. Suppose, so the moment I purchased your equity or share, so definitely the amount the amount, I just invested in your company, take in this way, and your company made the profit. So amount I invested, accordingly, you have to pay apart from this profit. So this amount of profit is known as a dividend. So the shareholders, equity holders, they are getting the dividends out of the profit made by this particular company. Clear? And I discussed you with also in the class, as profit, the total profit, I think we are not connecting there. Profit having the three components. One is your corporate tax, second is your dividend, third is your, remember, undistributed profit, retained earnings, like this, and savings of corporate sector. Clear? Right. Next, sir, please tell something about Operation Twist. Oh, just Operation Twist, if you understand what is that. Actually, this Operation Twist implemented in the USA economy first, and the later on we use this concept. So Operation Twist is basically, you imagine that 6-7 months back, 7-8 months back, in Indian economy, the trend was low rate of interest. The repo rate was lower, lending rate was lower, and all other rates like the deposit rates, everything was lower. So in this scenario, what was the condition that even the government was borrowing that time, during that time, they are offering at the low rate of interest, and people were buying that time. But just think about reference to that period before 10 years, 15 years back. So that time, the economy was, there was high rate of interest prevailing during that time, maybe 5 years back before that. So that time government issued in the economy definitely at the high rate of interest, because if you are not offering the market rate of interest which is prevailing in the country, so how the investors can invest in your securities? So you have to be competent and compatible, and you have to pay the interest rate which is prevailing in the market. So earlier government issued at the high rate of interest, but now during this period the market rate of interest was very low, and government was getting the fund at the low rate of interest. So what the government done, it just simply they done it, they borrowed from the market. They borrowed from the market the low rate of interest, and the same amount they paid it back in the long term, the earlier date. So net liabilities of the government remain same. Just I borrowed from the market, and that same amount I paid the earlier date. So earlier date was at the high rate of interest, and today's date is at the low rate of interest. So basically the government twisted these things. So net liability remains same to the government, but now on the same amount government is giving you at the low rate of interest. Why? Because the government rate of interest what they are offering, it is not subject to the market variations. Once government offered you at say 10%, 6%, 7%, whatever rate of interest they offered at the time of sale of securities, the same rate of interest will prevail till your policy. So that rate of interest is fixed. So earlier if they offered at the high rate of interest, they have to pay. So simply they can pay you back, okay, all the amount, and the new loan they have just created, but net liabilities remain same. So you can say it's Operation Twist. Clear? What is investment bank? Like Airtel Bank, how it works? Biswajit, investment bank, see, yeah, there are some categories of banks. Investment means bank, they are only meant for investment, long-term investment. So long-term investment banks considered as the investment bank. So generally they are not depending on short-term deposits like the demand deposits. IDBI, Industrial Development Bank of India, IDBI was the investment banks earlier. Later on they shifted to the normal banks. But IDBI mean to invest in the for long term for industrial development. So investment bank, you can say the bank which is meant only for investment purpose, that is for the long term. And they are generally depending on they are getting the resources from the institutions, okay, or the other schemes, but they are not depending on the demand deposits, because you understand in the banking system, not a single institutions can survive taking the short-term resources and lending it for the long term. Suppose I borrowed from you for 1 year, I can't lend it for the 5 years. I can't survive. So on the basis of short-term resources, not a single institution can go for the long-term investment. So for long-term investments, you need the resources for long-term, which is only possible either you are getting from any schemes or for the longer term scheme, because you have to pay back in the after long term. Like take the LIC. What the LIC is doing, that they are investing for the long-term projects. Okay. Right, but it's an insurance company. Insurance, they are investment because they have to earn, then only they can pay you. What is food coupon concept? Just think, but food coupon is normally is that because it is coming in the news. I think advertisement, food coupon you have to pay. So Biswajit, I think the so many things you will get in the future. You get it from the very normal and concept. Even in the advertisement, I think the same advertisement you have seen it. I also seen it. Like if you are just giving to a beggar some amount, maybe today it's true. The begging in the country is the organized one. Organized one. Organized begging system means in a particular area is controlled by the mafias. It's true in some of the streets, even the movie are based on this concept. And I think I think our the system knowing about that, they are aware about that. In some of the areas, okay, bagging is the organized one. It's a business, it's a business. So what you are just what you are seeing in this news, I mean the advertisement, not news, advertisement, okay, it's a fact to some extent, because the bakers, they are asking money from you and you are giving it. So their boss or the regulator, they are taking the money from them. So the basically you are giving this money to the beggar, seeing him the conditions, the physical conditions, and the condition of the, I mean, the way they are staying in front of you. You giving that, you are giving to them, but actually this money goes to the, I mean their boss or the organized persons. So what is the concept? Is that the food coupon? So you have to buy the food coupon. Suppose you want to say, in this month, my income is this. So say 1,000 I want to distribute to the, I mean the beggar and these things. So 1,000 food coupon you buy from the institute or institution. They are issuing it, and they are liable to pay this money, the food coupon money, to the concerned company. So you issued it. So when you are going to any shops, maybe on for food shops, then so in place of giving cash, you are just give it the food coupon. They will scan it. They will just give you food, and this coupon will redeemed to the company they issued it. This is the way simple. And food coupon also we are using. Yeah, it's one of the way, one of the concept. Food coupons are also used in the government sector, because sometimes government is not able to distribute the food grains through the PDS system under the National Food Security Act. So government also gives you the food coupon. It is also true, but same concept. You take the food coupon, go to the shops, they will give you, they already given this one, you can go, you are going that, you can get that much of food grains from that, and that shopkeeper or the issue of the food grains, they are going to claim to the government the amount. Simple. This way also you can do that. So you can use in the government sector also, and you can use in the normal what you are getting this one. Clear? Okay, Biswajit, and next you are asking, sir, what is the minimum alternative tax? Okay, but suppose it's not coming to the any tax provisions, and it's very difficult to monetize and difficult to find out okay, what is the volume of your output, what is the volume of this. So minimum tax is fixed. Okay, this is the minimum amount you have to pay irrespective of your volume of the trade. That is a minimum alternative tax. Clear? Okay, dear. So we will meet after the break. If you have any questions, any doubts, so some things about the develop growth and development and banking systems that I will discuss, and I will end this your syllabus today. Thank you. We are meeting after break. Thank you. Thank you. Take care, sir.